So hello everyone, and I hope everyone is having a good Easter and is safe and healthy, and their family is good and healthy. This has been quite a challenge for everybody, including you people and me. Okay, I want to do Chapter 8. I want to start doing some stuff on Chapter 8. Chapter 8 concerns itself with risk and return. Okay? So, we're going to talk about risk and return a lot. Now, there's a kind of something you got to remember. If you want a large risk, you're going to take a larger return, right? So the question is, what is risk, right? And it's a measure of the uncertainty surrounding the return that an investment will earn. So as you know, I was in the market before the coronavirus took to the airwaves and before we really knew much about it. So I take a lot of risk. And the risk showed up as the coronavirus, and I lost $500,000 over the that period. Okay, so the other question is, what is return? The total rate of return is the total. Now this is total, diversified and undiversified. The total gain or loss experienced on an investment over a given period, expressed as a percentage of the investment's value, calculated by dividing the asset's cash distributions during the period plus the change in value by its beginning of period value. In other words, the dividends and the capital gains, right? All right. So that's that. Okay. So here's the equation for holding period return, which we talked about, and this gives you the total rate of return, the cash distributions, plus the capital gains, the change in price, right? If you sell. Remember, you only have to pay taxes on capital gains if you sell. And everything is defined here where each of these terms are, right? The price before, this is the price before, the price after, and here's your, if you get dividends, and this could be even bonds, right? The before and after. Okay, it could be anything, an ETF, a mutual fund, right? So here's an example. And I won't go over these examples because these are in the book and they're here to save a little time. If you have any questions on how the examples are calculated, I want you to email me and ask me questions, all right, based on what you see here. But basically, these are the annual rate of return for Apple and Walmart with some numbers that they've had. Okay. And you can see here that Walmart had a larger return than Apple, right? All right. So, but basically, even though you got a larger return, right? Her profit in dollar terms was greater with Apple, right? So, because I think she had a larger percentage in there, right? Let's go back and just take a look, all right? All right, so Apple stock traded for $105.35, right? And Walmart was $69.12. But even though the Walmart stock was return was higher, the dollar value, amount was much higher for Apple. All right. So you go through that. Okay, so how do we look at return? And return is the total rate of return. And basically what you have is your realized. Now, realized return is what you actually got, right? You actually got your realized return. It came in the mail or whatever. Now, your expected return is the return that an asset is expected to generate in the future. Okay? Now, you notice the word expected, composed of a risk-free rate plus a risk premium. Okay? Now, there's another return that's not here, and I just want to make a point of it, and it's your required return. So there's really like 3 returns, right? There's actually many more, but the required return is what you actually require, okay? And then the expected is you may require something, but you really only expect it because you got some recent news that things weren't too good. And after you expected that, and after you required that, you realized only a smaller return or a bigger return, right? So realize is what you actually received, okay? All right, so I want to show you, there's a couple, there's three things here you should look at. All right. And here's Treasury bills. Remember, these are risk-free, right? There's no risk. You'll always get your money back. These are short-term, a year or less. This is Treasury bonds. Maybe 3, 5, 10, and maybe 30 years. And here's common stocks. And here's the average nominal return over the last 116 years, I suppose, here, right? And here's the average real return, okay? When you take into account risk premiums and everything, right? So and risk, okay? This is the nominal, and this is with risk, all right? So this is your average real return. And inflation, of course. All right, so there are people who have different risk preferences, and everyone has different preferences in life, right? So there are people who seek risk. Now, people who seek risk, I guess like gamblers, right? People go to Atlantic City or go to Vegas. They prefer investments with greater risk, and of course, most of them lose in Vegas, right? And they have lower expected returns because remember, the house always wins in the gambling houses. And then there are people who are risk neutral, and people who are risk neutral are just going to choose the investment with the higher expected return, and they don't care about the level of risk. They just want the largest return, and they'll worry about the risk later. And then there's people who are risk averse, right? And the attitude toward risk in which investors require an increased expected return as compensation for an increase in risk. Now, this is most people, right? This is most people. So I'm going to highlight this because this is, kind of important, right? This is most people. They want this kind of return, right? And I guess I'll save that, right? Okay, so there's a lot of ways of looking at risk. There's risk, first of all, of a single asset, right? And you can look at a risk from a scenario analysis point of view. And that's an approach for, basically you assess risk that uses several possible alternative outcomes, scenarios, and you obtain a sense of the variability among returns. And then there's ranges, a measure of an asset's risk, which is found by subtracting the return associated with the pessimistic outcome, the worst, right, from the return associated with the best, optimistic. So there are two words here, pessimistic and optimistic, right? So there's going to be a range in your returns here, okay? So I just want to make everyone aware of that. All right, so there's an example here. And you can go over this example, okay? And again, anytime you have a problem with an example, see me. I don't want to waste too much time on examples here. So here's two assets, okay? Here are two assets, A and B. And your initial investment in both of them is $10,000. And basically, there's a range of returns you're going to see. If things don't go well for A, you're going to get 13. If normally you'll get 15, and if things go real well, you're going to get 17. So you can see the range from low to high is 4, right? 17 minus 13 is 4. And for asset B, it's the same kind of thing, right? So the range from high to low will be what? A difference of 16, right? 23 minus 7 is 16. All right, so two assets. Now this one, let's just discuss this for a minute. This is more riskier. Why is this more riskier? Because there's a larger range, okay? This is a lot more tighter, right, in the range you're going to get. And this is a lot more spread out, okay? And in a little while, we're going to talk about standard deviation and that type of stuff and expected return. Don't worry, the equations are coming. In fact, here it is now, probability distributions. So we're going to talk about probability distributions, and you've probably heard the term standard deviation and variance, right? I'm sure you've seen that other places, right? So, and we're gonna look at bar charts and these continuous probability distributions. Let me see if I can move this up a little bit here. We got a little messed up here. Let me just fix this. Let me just slide this up. And now I'll slide this up. Okay. I'll save this. So we're going to look at a couple of bar charts now, right? So here's some bar charts. And here's asset A and here's asset B. And you can see already that this is more spread out, right? So there's more risk here. This is spread out. Notice how tight this is for asset A. So you're going to find out right away that the more spread out the returns are, the more risk you're going to have, right? All right, so Norman's Company's past estimates indicate that the probability of the pessimistic, most likely, and optimistic outcomes are 25, 50, and 25 respectively, right? Percentage. Note that the sum of these probabilities must equal 100%. So remember, the probabilities always have to equal 100. That is, the probability distribution must assign a probability to every possible outcome such that no other outcomes are possible. Okay? And you could read this about the book, The Black Swan. So this is like a really interesting book, right, by Nassim Taleb. And I'll just highlight this because it's a good book. These are called Black Swan events, like we just had with the coronavirus, right? That was a Black Swan event. Kind of just popped in, right? Okay, so here you go again. Here is CocaCola. You'll notice this is a little more tighter. Their returns don't vary as much. Well, look at Google. Notice how Google is spread out. So there's more risk associated with Google here. Okay? So, okay, so there's two things we're going to talk about with regard to a single asset. We're going to talk about expected return. All right? Let me get that. So it's all red. Okay? All right. And then we're going to talk about, so this is the equation of expected return. Everyone see that? So this is expected return. So I just want to make sure everyone's clear because this is not standard deviation. Let me move this a little further down. So here, okay? So let me maybe stick an arrow. Let me put in an arrow here. Let me grab an arrow. And this is expected return, okay? Just so everyone's clear, because it says standard deviation. So we take, to get the expected return, we take the return of the stock, right? It's a single stock, and multiply it by the probability of getting that. But there could be different returns for different scenarios, right? So there could be a probability it's high, medium, low, and there's a risk associated with each. So we just find that the expected average return here, and we basically get the, expected return by add. This is sigma. This means add up. So if I have 4 or 5 different returns for different probabilities here, these are different probabilities. I would add them up, and I would get the expected return. Okay. All right, now, once you got the expected return, you got to know how much risk you're taking, right? So there's another way to get you can get the average return. This is another thing, okay? This is average return, which is different than expected return. And there's another way of calculating this, all right? And this is the average return, and you estimate this because you know basically the historical returns already. You notice what I'm saying? There's no probabilities here because it already happened. So you know that. So this is you take the arithmetic mean to get the average return. And I keep hitting things. All right. Well, that stays there. Okay. So, all right. So I want to make sure everyone's clear about that. All right, so here's an example in your book. All right, so please go over this example, 8.4. This is in your book, and if you don't understand it, let me know. And so here's how you get the expected return. All right, so here's the three probabilities associated with asset A and three probabilities associated with asset B. So let me highlight. Let's tell you what. Here's asset A. Let me highlight that. And here's asset B. Okay. I'll save that. So here's the probabilities for each of these conditions, and these are the returns associated with these. So watch how simple this is. Multiply this times this, multiply this times this, and multiply this times this. Notice they add up to 100, and then you'll basically get, you take these three numbers here, and then you add them up, and you get the average return. So notice for both asset A and asset B, they have the same average return. But the question is, what about the risk? So we got to talk about the risk, right? All right, so here is the risk measurement. This is the standard deviation we were talking about, and this will give us the risk. So this is the standard deviation of the returns. And basically what you do is you take each return we saw, subtract off the average return, which I believe was 15, square it, multiply it by the probability, and then you add them up and you take the square root. Okay? So that's how you do it if you got probabilities looking toward the future. And here's how you do it if you already have historical data. Okay? So this is with historical data in the past. There's no probabilities because you have it all. So you would just use this equation. And you could use X. This is built into Excel right here. This is in Microsoft Excel. So let me put C Microsoft Excel. Okay, because this is built into, and you should try that. You should try that, okay? All right, so here's another example from your book. And here's the two standard deviations we were talking about. Standard deviation for asset A is 1.41, right? Now, the higher the standard deviation, the higher the risk. Everyone should know that, all right? And for the standard deviation for asset B is, whoops, hold on. Oh, I got to go back. I think I moved something. And the standard deviation for asset B is 5.66. So obviously asset B has got a higher standard deviation, right? And thus is more riskier. All right, so the important thing, the higher the standard deviation, the greater the risk. The higher volatility of asset B's return is clearly reflected in the higher standard deviation. Okay? Everyone should make sure you're aware of that, all right? All right, so here is table 8.4 for asset A and asset B. Now you'll notice that the standard deviation here, we calculated, it's 1.41 for asset A, and it's 5.66 for asset B. Therefore, asset B has the higher risk because it has the highest standard deviation. All right? So I just want to make that clear. All right, so here's the thing about a blurb about stocks and different types of stocks. And small stocks have a higher risk, and they also have higher returns, right? All right, so here's the average nominal return for those things again, the treasuries, the treasury bills, bonds, and common stocks. Here's the standard deviation, And here's this thing called the coefficient of variation, okay, which we'll talk about in a bit, okay? So we'll talk about we haven't talked about the coefficient of variation yet, okay? So notice that common stocks have the higher risk. Everyone see that right there? Much higher risk. So, and you know Treasury bills are risk-free and they pay a lower return. So they have a much lower risk, a much lower standard deviation. All right, so I'm going to make another part now. We're about 20 minutes into this. I'll make a part 2. But basically, we're going to talk about the normal probability distribution. And that's going to be you probably saw it, a bell-shaped curve that lets you know how much risk you have, okay? So I'll highlight this because this is important. All right, and I'll save this and I'll make a part 2 later, okay? All righty.